The United States has constructed the most complex sanctions framework ever seen in modern history. More than 40,000 separate designation entries are maintained by the Office of Foreign Assets Control. Entire national economies have been placed under pressure. Banking institutions have been cut off from access to the international financial network. Individuals have had their financial assets locked and restricted from use. The position of the dollar as the primary global reserve currency has been turned into a highly precise instrument of economic pressure. For roughly 3 decades, this structure functioned with near complete success. The only real alternative to following the rules was exclusion from the world's most significant consumer base and its most active capital markets. India has now bypassed that structure in a direct and highly systematic way. This did not happen quietly or indirectly. It unfolded openly over a period of 3 years, with each transaction recorded in detail by a state fully aware of the implications and calculating that the outcomes would remain manageable. The total figure is $35 billion. This represents the estimated value of discounted Russian crude oil that India acquired between February of 2022 and the end of 2024, despite sanctions designed to limit Russia's energy income. To place this scale in perspective, $35 billion is close to the total annual economic output of Estonia. It also equals enough funding to sustain the United States Marine Corps for nearly 3 years. Every unit of value moved from Indian refining companies to Russian suppliers through financial pathways that avoided the dollar-centered sanction structure that Washington had developed over 30 years. What makes this development historically important is not only its size. India is not classified as an adversary state in Western policy. It is not positioned like Iran or Russia in geopolitical frameworks. It is instead treated as a strategic partner, a member of the Quad alignment, and a key component of Indo-Pacific policy planning. It is also a nation recently engaged in high-level diplomatic engagement with the United States involving 22 corporate chief executives during a major bilateral visit. If a state like India can conduct 40,000 sanction-relevant interactions without facing meaningful consequences, then the effectiveness of the system is not what its designers assumed. This suggests that the structure of sanctions enforcement may not be universally binding in practice. If that is the case, the primary non-military instrument of economic pressure used over the last 3 decades may not hold the level of control that foreign policy doctrine has long attributed to it. This represents a structural change, rather than a minor adjustment in global financial power. Yet, its implications are still not fully addressed in mainstream analysis. The method used by India to carry out these purchases without triggering sanctions mechanisms is based on a multi-layered financial arrangement. The first layer involved replacing currency dependence. India and Russia agreed to conduct a portion of crude transactions using Indian rupees instead of United States dollars. This created complications, since Russia accumulated large rupee reserves that could not easily be converted into other needed currencies. This surplus condition created what economists describe as an excess rupee holding problem, which required further coordination between both sides. Even so, the core principle was established. Large commodity trade can occur outside dollar-based settlement systems. The second layer involved maritime transport networks operating outside Western insurance and shipping controls. Instead of using vessels insured under the Lloyd's of London system, which is influenced by Western regulatory pressure, shipments of Russian crude were carried by ships linked to operators in the United Arab Emirates, Turkey, India, and other jurisdictions not enforcing Western restrictions. By the middle of 2023, international maritime tracking estimates suggested that more than 600 vessels were operating outside the conventional Western insurance structure. India's import demand contributed to sustaining this fleet commercially. The third layer focused on refining and re-export activity. India's refinery sector, including major companies such as Reliance Industries and Indian Oil Corporation, processed Russian crude into refined fuels like diesel, jet fuel, and petrochemical products. These outputs were then exported globally under Indian certification. This created a regulatory separation between the original source of crude and the final exported product, which was legally classified as Indian origin fuel in international markets. Financial settlement methods combined rupee-based transactions with intermediary currency routing, involving the United Arab Emirates dirham and conversions linked to the Chinese yuan. When necessary, transactions bypassed the SWIFT messaging system entirely. Parallel settlement agreements between the Bank of Russia and the Reserve Bank of India supported direct bilateral clearing mechanisms without reliance on dollar intermediation. All of these transactions remained compliant within Indian domestic law and financial regulation. Because the entities involved operated under Indian jurisdiction, they did not fall under direct enforcement authority of United States sanctions policy. This model is not exclusive to India. Similar structures have been observed in Turkey and in the United Arab Emirates, which has become a major transit hub for goods moving between Russia and global markets. China has also absorbed significant volumes of Russian energy exports. However, India's position is distinct because it operates within Western-aligned strategic frameworks while simultaneously participating in this alternative trade architecture. This dual positioning places India inside cooperative security structures while remaining outside enforcement compliance in this specific domain. The strategic cost of confronting India on this issue was assessed as higher than the benefit of enforcement, leading to an implicit tolerance of the arrangement. Once such an exception exists, it changes how other states evaluate the system. It signals that enforcement is not absolute, but conditional on strategic priorities. 5 million barrels of crude oil per day is the scale involved. At a discount of $25 per barrel, the savings reach $112.5 million each day. On an annual basis, this translates to roughly $41 billion. To understand the magnitude, $41 billion per year is close to India's total yearly spending on education. It is about twice the country's annual defense capital outlay. It exceeds the gross domestic product of 70 separate nations. In simple arithmetic terms, the financial motivation to continue bypassing sanctions is extremely strong. The geopolitical risks linked to such actions exist, but they were assessed as controllable because India calculated that its strategic position within United States Indo-Pacific policy provided a form of protection against serious punitive measures. This is not a theoretical assumption. Indian government officials, along with policy analysts connected to strategic institutions, have described this calculation in off-record discussions with researchers. The underlying view is that India's importance to United States regional strategy functions as a safeguard against escalation in sanctions enforcement. In practice, that calculation proved accurate. No secondary sanctions were placed on Indian banking institutions or energy firms. There were no restrictions imposed on India's access to dollar-based payment infrastructure. No targeted tariffs were introduced specifically against Indian refined petroleum products derived from Russian crude. Instead, responses were limited to diplomatic statements of concern, which did not result in any change in behavior. This outcome has been closely observed by finance ministries and central banks across non-Western economies. The interpretation drawn from it is not that India has exceptional treatment, but that countries with sufficient scale, economic weight, and strategic relevance can operate at the edges of the sanctions framework while managing risk exposure. From this perspective, if India can sustain such an arrangement, other states begin to reassess their own constraints and possibilities. A report from the Congressional Research Service released in late 2023 observed a measurable decline in sanctions effectiveness across multiple targeted regimes since 2020. Despite representing the largest coordinated sanctions effort ever implemented, the Russia sanctions did not stop Russia from funding its military operations. Alternative financial channels, many involving countries aligned in varying degrees with Western systems, continued to provide sufficient revenue flow. The experience of Russia sanctions, combined with India's participation in related energy trade flows, is expected to influence how economic coercion is evaluated in future policy planning. Beneath this immediate development lies a deeper structural shift. The issue is not limited to the effectiveness of a single sanctions program, but rather the stability of the broader dollar-centered financial architecture. The United States holds a unique position in global finance because the dollar functions as the dominant reserve currency. International commodity trade is largely denominated in dollars. The SWIFT messaging system operates through correspondent banking channels tied to dollar liquidity. Central banks worldwide maintain dollar reserves as part of their foreign exchange management. This structure gives the United States the ability to impose financial pressure on states that depend on integration with global markets. This mechanism is commonly referred to as dollar-based financial leverage. For approximately 30 years, it has been one of the most powerful instruments in United States foreign policy. Its effectiveness relies heavily on network effects. When more countries use the dollar for trade settlement, the utility of the dollar increases for all participants. When more banks connect to dollar correspondent systems, the system becomes more central to global finance. When more central banks hold dollar reserves, demand for United States Treasury securities remains structurally supported, contributing to lower yields than might otherwise occur. However, these same network effects also operate in reverse. Each transaction conducted outside the dollar system slightly reduces the relative advantage of dollar settlement. Each reduction in dollar reserves held by central banks exerts marginal upward pressure on treasury yields. Each commodity trade, completed in alternative currencies, increases the viability of future non-dollar transactions. Individually, these shifts are small. Over time and with sufficient scale, they begin to reinforce each other and accelerate. India's rupee-ruble settlement arrangements, Turkey's lira-based trade mechanisms with Russia, China's yuan-denominated oil purchases from Saudi Arabia, Brazil's real-based trade structures with China, and the United Arab Emirates' dirham-mediated transactions and restricted trade flows all represent components of an emerging parallel settlement ecosystem. None of these systems alone challenges dollar dominance. However, together, they form a gradually expanding alternative financial network that did not exist a decade ago and continues to gain functionality through repeated use. The Society for Worldwide Interbank Financial Telecommunication, known as SWIFT, processes approximately 42 million financial messages each day across more than 200 countries and territories. Russia was removed from SWIFT in February of 2022 as part of coordinated sanctions measures. The expected outcome was a breakdown in Russia's ability to conduct international financial transactions. Instead, alternative systems expanded rapidly. These included Russia's SPFS system, China's CIPS network, and a growing set of bilateral banking arrangements designed to bypass SWIFT entirely. By late 2024, an estimated 30 to 35% of Russia's international financial activity was being processed through non-SWIFT channels, compared to nearly zero at the beginning of 2022. The unintended effect of excluding Russia from SWIFT was to demonstrate that the system could be bypassed, which reduced the credibility of future exclusion threats. India's participation in Russian crude oil trade utilized several of these alternative mechanisms. Through this process, financial institutions in India and Russia accumulated operational experience in non-SWIFT settlement systems, capabilities that remain in place regardless of future geopolitical developments. The Office of Foreign Assets Control has spent 3 decades building a sanctions framework based on the assumption that dollar universality is structurally permanent. India's actions highlight that this assumption is conditional rather than absolute. It depends on continued global preference for dollar settlement over available alternatives. As those alternatives expand and become more efficient, the universality of the dollar system becomes less guaranteed. As that universality weakens, the effectiveness of sanctions mechanisms built upon it declines in parallel. The cross-border interbank payment system, known as CIPS, was launched by China in 2015 and has expanded rapidly since 2022. It offers a yuan-based alternative to the dollar-centered SWIFT messaging framework. By 2024, CIPS had linked more than 1,400 financial institutions across 109 countries. Not every institution connected to CIPS uses it for transactions that bypass Western sanctions. Many participants rely on it simply because yuan settlement is practical for trade linked to China. However, the underlying infrastructure is identical, and that infrastructure also enables sanctions circumvention pathways. China developed and operates this system. China also played a facilitating role in the United Arab Emirates, becoming a central hub for Russian commodity flows into global markets through layered triangular trade structures. Chinese firms, frequently operating through UAE-registered entities, became active participants in the logistical networks supporting the movement of Russian crude through shadow fleet operations. In addition, Chinese banking institutions contributed technical financial expertise that supported currency substitution arrangements. These mechanisms allowed India to settle Russian energy imports outside of the dollar-based system. This reduced reliance on traditional Western financial channels. China did not publicly announce these activities. There were no official statements or press conferences outlining its involvement in constructing financial pathways that enabled countries such as India and Turkey to navigate around Western sanctions frameworks. Instead, the approach was to build infrastructure, connect counterparties, and allow economic incentives to shape usage patterns. The outcome of this process is that the most extensive coordinated sanctions package ever implemented against Russia did not succeed in fully isolating Russia from revenue streams required to sustain its military operations. The presence of alternative financial channels was a key factor in that outcome, and China's infrastructure played a central role in enabling those channels. This pattern appears repeatedly across major geopolitical developments in recent years. United States policy defines a problem and mobilizes allied economic pressure to address it. China develops or supports systems that allow key participants within that coalition to continue trade and financial activity outside the intended constraints. As a result, the coalition remains formally intact but becomes increasingly porous in practice. The effectiveness of American economic tools is therefore partial rather than absolute. At the same time, China's strategic position strengthens as global actors recognize that participation in alternative systems can reduce exposure to sanctions pressure. Multiple long-standing cases reflect this dynamic. Russia has faced sustained sanctions but remains active in global energy trade. Iran has operated under sanctions for approximately 45 years and continues to export oil. Venezuela has maintained energy exports through indirect channels. North Korea has preserved its weapons development programs. In each case, sanctions imposed real economic constraints but did not fully achieve intended political outcomes. Alternative trade routes and financial channels, many linked directly or indirectly to China, provided continuity. India's role in this environment is particularly significant because it is formally aligned with the United States in strategic frameworks designed to balance China's influence in the Indo-Pacific region. The Quad is structured around that objective. However, India's participation in Russian energy trade and its integration into alternative settlement systems reveals a structural tension within that alignment. It demonstrates that members of the same strategic coalition are simultaneously engaged in economic behavior that supports parallel financial architecture outside the dollar system. This is not presented as criticism of India. The behavior reflects rational national interest. However, it exposes a limitation in the assumption that strategic alignment automatically translates into unified economic behavior. Countries within the coalition are balancing multiple priorities, including energy security, cost efficiency, and long-term economic flexibility. From this perspective, the idea that countries must choose strictly between alignment with the dollar system or isolation is weakening. China's position is central here, not as an actor forcing confrontation, but as an architect of systems that allow states to operate outside that binary structure while maintaining global trade access. Each successful instance of sanctions avoidance without major consequences reduces the perceived rigidity of the system. India's participation in Russian crude oil trade has become a major demonstration of that flexibility. China's infrastructure development over the past decade has provided the technical and financial foundation that makes such flexibility operational. The consequences of this development are not immediate or linear. They unfold through multiple reinforcing feedback loops. The first effect is behavioral. Finance ministries and central banks that previously complied with Western sanctions out of caution are reassessing risk exposure. If a large economy with significant strategic ties to the United States can engage in sanctioned trade volumes of approximately $35 billion without facing direct punitive action, then the assumed cost of deviation is reduced. This leads to gradual, incremental adjustments in compliance behavior across multiple jurisdictions, rather than sudden policy shifts. The second effect is infrastructural. Alternative payment and settlement systems used in these transactions have expanded in scale and efficiency since 2022. They now process higher volumes, operate with reduced friction, and offer improved reliability compared to earlier stages of development. As usage increases, system performance improves, which in turn attracts further participation. This creates a reinforcing cycle of adoption and functionality. The third effect operates on a longer timeline and carries broader strategic implications. If the dollar's role as the universal settlement currency weakens even partially, the reliability of sanctions as an enforcement mechanism declines. Countries subject to sanctions gain greater ability to redirect trade through alternative channels. As a result, economic coercion becomes a more costly instrument that produces less predictable outcomes. Over time, policymakers may become more cautious in deploying sanctions, not due to ideological opposition, but due to shifting cost-benefit assessments. The question that follows is what replaces sanctions as a primary instrument of foreign policy if their credibility declines. Historically, responses have included diplomatic adjustment or military action. Neither option is straightforward in a multipolar global environment characterized by overlapping economic dependencies and high strategic risk. Diplomatic adjustment may require acceptance of outcomes that face domestic political resistance. Military escalation carries substantial economic and strategic costs, as demonstrated by prior conflicts in Afghanistan and Iraq, which shaped the risk calculations of an entire generation of policymakers. From a financial perspective, these developments imply a gradual structural shift. Dollar-denominated assets may experience incremental pressure from diversification of foreign exchange reserves. United States Treasury yields may face long-term upward pressure if global demand for dollar reserves becomes less automatic. The assumption that American economic leverage functions as a stabilizing backstop for the global financial system becomes progressively less certain. These are not abrupt disruptions. They are slow-moving structural changes that accumulate over time and reinforce each other through continuous global interaction. Stay with this analysis for the next part.